As of today, Thursday, December 18, 2025, ARM Holdings PLC is currently trading at 113.33 USD, seeing an intraday drop of about 6.73% as the market processes a series of high-level shifts in the semiconductor landscape. While the general sentiment around chip designers often leans toward aggressive growth, what most investors are missing right now is the massive disconnect between the sheer volume of chips using ARM designs and the actual dollar amount the company captures from each one. You might look at that price drop and think it is just another volatile day in the tech sector, but the reality is that the market is beginning to question the sustainability of ARM's pricing power in a world where open-source alternatives like RISC-V are starting to breathe down their neck. It is one thing to be the architecture of choice for every smartphone on the planet, but it is another thing entirely to convince hyperscalers and automotive giants that they should keep paying a premium for that privilege when they have the resources to build their own custom instruction sets. Most of you probably know ARM as the company that SoftBank saved from obscurity, or perhaps you see them as the silent engine behind your iPhone. The common expectation is that as artificial intelligence scales, ARM will naturally be the primary beneficiary because their architecture is inherently more power efficient than the traditional x86 designs from Intel. That narrative has pushed the stock to some incredible highs over the past year. However, the contrarian view, the one that sophisticated players on the Interactive Brokers trading platform are looking at, is that ARM's growth is no longer just about volume. It is about a desperate race to move clients from older, cheaper licenses to the newer high-royalty V9 architecture and their compute subsystems. If they cannot force that migration fast enough, the massive valuation we are seeing today starts to look a lot more fragile. Looking at the recent stock movement, we have seen a significant amount of institutional activity over the last few trading sessions. While retail traders on the Robinhood app might be buying the dip, large-scale funds are showing signs of caution. The volume today is trending higher than the 30-day average, which usually suggests that the big players are repositioning. We have seen some heavy selling pressure coming off the back of recent earnings where, despite beating expectations on the top and bottom lines, the guidance for the next fiscal year felt a bit too conservative for a company trading at such a high price-to-earnings multiple. This creates a tension. The company is performing well fundamentally, but the market's expectation was for something closer to perfection. When you are priced for perfection and you only deliver great, the stock often pays the price. Part of this pressure is coming from the broader macroeconomic environment. We are seeing a bit of a rotation out of high-growth tech as interest rate uncertainty lingers into the end of 2025. For those using Schwab Intelligent Portfolios or other automated online investment tools, you might have noticed your tech exposure being trimmed. ARM is particularly sensitive to these shifts because so much of its value is backloaded into future cash flows. If you were an individual investor managing your own individual brokerage account at Fidelity, you have to ask yourself if you are comfortable holding a stock that essentially requires a total takeover of the data center market just to justify its current price. The daily swings we are seeing are also tied to the ongoing legal and licensing drama with some of their largest partners. The relationship with Qualcomm is a perfect example of the expectation versus reality trap. The expectation was that these two would always be partners. One provides the blueprints, the other builds the house. The reality is a bitter legal battle over licensing fees that could fundamentally change how much revenue ARM can extract from the laptop and PC market. If ARM wins, their royalty rates could skyrocket. If they lose, it sets a precedent that could empower other giants like Samsung or even Apple to push back on their fee structures. This uncertainty is exactly what drives the kind of intraday volatility we are seeing at 113.33 USD. Let's talk about the business model for a second, because it's fundamentally different from a company like NVIDIA. While NVIDIA stock moves based on how many physical H100 or Blackwell GPUs they can ship, ARM doesn't actually make anything physical. They are an intellectual property company. They design the language that hardware uses to talk to software. When a company like Apple or Amazon wants to build a custom chip, they license ARM's architecture. They pay an upfront fee to access the designs and then a royalty for every single chip that eventually leaves the factory. This is why Fidelity Investments and Fidelity Mutual Funds often hold ARM. It's a high-margin, recurring revenue business that looks a lot like a software company but lives in the hardware world. In the past, ARM was almost entirely dependent on the smartphone market. That was their bread and butter. But as that market matured, they realized they needed to expand. They have spent the last few years aggressively moving into the data center and automotive sectors. This is where the real excitement lies. If you go on the Robinhood Investments tab and look at the analyst reports, they'll tell you that the Neoverse platform is the future. These are designed specifically for servers. For years, Intel and AMD owned the server room. Now, AWS has Graviton, Google has Axion, and Microsoft has Cobalt, all of which are built on ARM. This shift is a massive tailwind, but it also means ARM is now competing with some of the most powerful companies on Earth who might eventually decide they don't want to pay a licensing fee to a third party. For those of you doing your own investment help research or using investing sites to track your self-investing progress, it's important to understand the role of SoftBank here. Masayoshi Son still owns the vast majority of this company. This creates a bit of a supply overhang. The market knows that eventually SoftBank will want to monetize more of its stake. Every time the stock hits a new high, there is a lingering fear that a massive block of shares could hit the market, diluting current holders. This is a dynamic you don't really see with Apple stock or other big tech names, and it adds an extra layer of risk that isn't always captured in the basic financial metrics. Now, I want to hear from you. Comment below with how many shares of ARM Holdings you are currently holding in your Fidelity brokerage or Robinhood stock trading account. Do you think the high valuation is justified by the AI boom, or are we looking at a bubble that's starting to leak? I'm curious to see where the community stands on this one. Looking ahead, the future outlook for ARM is a game of high-stakes chess. The primary catalyst to watch in the coming months is the adoption rate of the V9 architecture. This version allows ARM to charge roughly double the royalty rate of the previous generation. If they can successfully transition the bulk of the smartphone market and the emerging AI PC market to V9, their revenue could see a massive spike without them having to sell a single extra unit. This is the reality that could exceed the market's already high expectations. On the flip side, the risk is the aforementioned RISC-V. This is an open standard architecture that is completely free to use. While it isn't yet ready to replace ARM in high-end smartphones or servers, it is making massive inroads in the Internet of Things and automotive sectors. If ARM loses the low end of the market, they lose the volume that has historically been their safety net. We also have to consider the physical AI angle. ARM is positioning itself as the foundational layer for robotics and edge computing. The idea is that for a robot to move and react in real time, it needs massive processing power with very low power consumption, exactly what ARM is good at. If this sector takes off in 2026, we could see a whole new royalty stream that isn't even being factored into most SoFi investing or interactive brokers models yet. This is the kind of hidden growth potential that keeps long-term bulls interested even when the stock is having a rough day like today. Whether you are using the Fidelity mobile app, the SoFi trading platform, or just checking your Robinhood crypto and stock balances, you have to realize that ARM is a proxy for the entire tech ecosystem. It is the most diversified play in the semiconductor space because they touch everything from a $5 smart bulb to a $1 million server rack. But being everywhere means you are vulnerable to everything. A trade war with China? That hits ARM because of their complicated complicated relationship with ARM China. A slowdown in consumer spending, that hits their smartphone royalties. A breakthrough in a different type of computing architecture, that hits their long-term moat. For the investors who prefer a more hands-off approach through Fidelity Wealth Management or SoFi Robo-Advisor services, ARM is likely a core holding in your tech ETFs. You are essentially betting on the continued ARMification of the world. And to be fair, that has been a winning bet for a long time. The company's non-GAAP operating margins are sitting at over 40%, which is incredible for a company of this scale. They have over $3 billion in cash and a debt-to-equity ratio that would make most tech companies jealous. Fundamentally, the company is a fortress. The only question is whether the price you have to pay to get into that fortress is too high. In summary, we're looking at a company that has successfully navigated the transition from a mobile-only player to a legitimate force in the data center and AI space. The live price of $113.33 USD reflects a market that is currently skeptical, balancing the long-term potential of the V9 royalty bump against the immediate pressures of